suis très heureux d'être.
I'm very pleased to be with you today for this luncheon meeting, and thank you all for being here. And I'm especially pleased as a Francophone Quebecer to have this opportunity to speak French here in Toronto. I would like today to discuss a subject that isn't very popular and that a number of people consider to be rather complicated. I would like to talk about currency. It's true that monetary policies are among the most difficult issues in economics, but at the same time, this is a subject of crucial importance for the prosperity and future of our country, and that's why I would like to talk about monetary policy and currency today. As you know, you are workers, you are consumers, and every single day you use money. You use money for all kinds of transactions, and every single day you think about the cost of the goods and services that you purchase. At the same time, every single day, you ask yourself whether your savings are going to grow or whether the cost of your mortgage is going to go up as a result of an increase in interest rates. In other words, monetary issues affect all of us directly. And it's important to understand them, particularly if you're in business or where you also have to plan your business activities or how to grow your business. But the argument I want to develop today is that government control over currency through the central banks has serious consequences that few of our fellow citizens seem to be aware of. One of them is that central banks are constantly increasing the amount of money that circulates in the economy. And one example in Canada would be the fact that the money supply goes up 14 to 16% or has in the last 10 years. And I can tell you that it's the same thing for every developed country. Now, that creation of money from nothing, out of nothing, has very injurious effects. And one of those effects is that it depreciates the value of our dollar. It causes a continuous rise in costs as well. And despite what you may hear from certain economists or commentators on the radio or on television, prices do not go up because businesses want to make more profits. Prices do not go up because the cost of oil rises. Prices do not go up because wages are rising. But the only person responsible for rising prices is the central bank. And only the central bank can ensure that prices will go up by continuing to print more money. And so it's quite simple. When you think about money, well, money is like any other good. The more there is, the lower its value, and the more inflation there is. You might think of T-shirts, for example. That's one example. That's a consumer good that's quite harmless. But the more T-shirts are on the market, that means a lot of merchandise. That means the price will go down, and it's the same thing for currency. And the result is that inflation goes up. And here in Canada, the Bank of Canada has an inflation target of 2% per year, and that has been its target for 15 years. 2% is its inflation target on a yearly basis. Now that may seem like very little, but 2% inflation means 2% depreciation in our money year after year, and that ends up accumulating over time. And that means that from 1990 up until now, the value of our dollar is only 70 cents compared to what it was worth in 1990 by printing more money and creating 2% inflation every year for a 15-year period. What does that mean ultimately? Well, it means we end up with 45% inflation in Canada. Prices have increased by 45% since 1990 with an expansionist policy, inflation policy by the Bank of Canada. I'm not inventing this. All you have to do is go onto the Bank of Canada's site and you'll see there's a calculator for inflation and interest. And I put in 1990 up until now, and I got 2% inflation per year, which results in 45% inflation over a 20-year period. Now, the president of the U.S. Reserve, Ben Bernanke, admitted at one of his appearances before the U.S. Senate that inflation is the equivalent of a tax because we have to pay more money for the goods and services that we buy as a result. 45% more since 1990. And inflation is the worst possible kind of tax. It's an insidious tax that hits the poorest among us hardest. And what does that tax do? Well, it brings down the value of the money we have in our pockets. It diminishes the value of the money we have in our bank account. And it harms our buying power as well as our savings. And now, some of you may be asking yourselves a question in this room. 45% inflation, Maxime, in the last 20 years? Well, maybe you were not affected by this. Maybe personally your buying power did not drop. But the only way of knowing this is whether you got a wage increase of 45%. Did you have a 45% wage increase in 20 years? If you did not get a 45% wage increase since 1990, then you're poor and the Bank of Canada taxed you, and it's an insidious tax that no one even talks about here in Canada. So who is affected most by this tax? Well, it's the people who live with a fixed income, for example. An income that doesn't increase quick enough because prices are going up at the same time, and those people get poor as a result. That's the case for a large segment of the population. Their wages are not indexed to inflation. So if, as I said earlier, your wage did not go up by 45% since 1990, then you are poor now. But why? Why? If inflation is such a bad thing, why does it have a 2% inflation target on a yearly basis? Well, there are a number of interest groups that benefit from this and who like inflation, who like a larger money supply. The central banks have a natural tendency to like a larger money supply and low interest rates. Governments as well tend to like inflation, particularly if they're in debt. Because if you have a huge debt, like the U.S. government, for example, when you pay back that debt, when you pay it down, you're going to do it with devalued money. So who benefits from inflation? A very highly indebted government. And that monetary policy also has consequences that we may not like to see. One of them is by creating money out of nothing, there is a consequence, and that is that central banks want low interest rates, but the fact is that the performance on savings is lower in that case. And people tend to go more into debt because credit is easier to obtain. And what does that mean? Well, we know what it means, and that's exactly what happened in Canada, in the United States, and elsewhere in the Western world. And that has also been the case for the last 20 years. In 1990, the total debt of Canadian households in terms of the percentage of their available income was 90%. Today, in 2011, that debt ratio is almost 150%. And that is an historic high we've never seen before in this country, both here in Canada, actually, and in the U.S. So going into debt seems to have become a way of living, a way of life here in Canada. But fortunately for us, the public debt in Canada is at a reasonable level when we compare ourselves to other countries in the Western world, and for example, the United States. But a number of countries like Greece, Portugal, Ireland, the United States, are countries which are on the verge of bankruptcy because they became too dependent on easy credit. Why do I say that for the United States? Well, if you look at the economic facts, a few weeks ago, the U.S. Treasury Secretary, Mr. Gertner, asked once again that the U.S. Congress increase the U.S. government's cap or highest debt level. Why? Because otherwise the U.S. will default on its payments because they have a $14 billion deficit debt. What does that actually mean? It means that the country would be bankrupt. It means a company would be bankrupt if its situation were the same. So making money out of nothing, which is something done by central banks, also creates a lot of distortions on the market. And it's the cause of artificial boom and bust periods and the kind of crash that we regularly see. And it's not just Maxime Bernier saying that. That theory was developed by a Nobel Prize economist, Frederick Hayek, and those economists are called economists of the Austrian school because he was originally from Austria, this economist. And he received the Nobel Prize for analyzing these artificial booms and these actual crashes and busts that would occur, and they are now things that we see pretty well every decade. Every decade there's a recession, and this is due to the fact that the central banks intervene in the economy. I can give you an example of those distortionist effects when you make money out of nothing. You may recall that at the end of the 1990s there was a boom on the stock exchange, and that was due to the dot-coms. And when the bubble burst, the U.S. Federal Reserve, between 2001 and 2004, reduced interest rates down to 1%. And if we consider inflation, that means that the actual interest rate was negative during that period. And it's as though people were being subsidized to go into debt. What does that mean? What does it mean when you have a monetary policy, an expansionist monetary policy with artificially low interest rates? Well, it created another bubble. After that particular tech dot-com bubble and a crash, it created another real estate bubble and finance bubble in the U.S. and elsewhere in the world. In 2007-2008, that bubble that was created in the real estate and finance sectors burst. And we had the global economic crisis as a result. So we have to come out of the crisis. Now, did we learn the proper lessons? No. The central banks of most of these countries continued to lower their interest rates until they were practically at zero. That means that once again, interest rates, actual interest rates were negative because prices were going up faster.
Wow.
And personally, as a politician and as a Canadian and a citizen paying a disguised tax, I would like to understand why we adopt these kinds of monetary policies that affect our citizens in this way. How can we possibly expect to come out of a crisis when we foster debt? It's true that economic growth seems to be coming back to Canada. But to what extent will it be sustainable? Are we in a situation where we're experiencing an artificial boom? Are we creating another bubble in another area which will result in a global recession when that bubble bursts? And if that happens, What recovery plan will countries be able to introduce if they're so deeply in debt? So despite all the negative effects of inflation and the money supply, most economists and commentators, and that's what I said at the beginning of my statement, seem to believe that a little bit of inflation, just a little bit, is a good thing. And they say that deflation, in other words, a decrease in prices, would be a complete disaster for the economy. Their logic is that if prices go down and we have deflation, consumers will postpone their acquisitions and their purchases so that they can get even lower prices on what they buy. Well, I can tell you that that logic is completely false. It's not true. Let's just apply some common sense here and base ourselves on what we see in everyday life. As a consumer, do you prefer to buy goods that are more expensive or less expensive? I mean, I think the answer is obvious. We all know the answer to that question. We all are consumers, and we all benefit when prices go down. So, if we can spend less for a particular good, that means that we have more money, extra money, to buy other goods. And economic activity doesn't stop because of that. It simply means that when prices go down, we can buy more things with the same amount of money, and that we have greater buying power, and with greater buying power, we are able to have a better standard of living. So the reality really isn't that mysterious in terms of lower prices. Let's take the case of computers. 15 years ago, computers were big, not very effective or efficient. They had very few gadgets, and they cost a lot more than they do now. Well, since then, prices in the computer industry have continued to go down year after year. Did people stop buying computers? Or did they wait years before they bought computers, thinking to themselves, oh, well, the price is going to go down, so I'm going to wait to buy a computer? No, absolutely not. On the contrary, there are more and more computers being sold year after year. In the 19th century, there were no central banks. Currency was calculated based on gold bullion. Unlike today, monetary growth was very, very low, and because of an increase in productivity, such as is the case in the computer industry, prices would go down in every single sector. There was general deflation in the 19th century, and yet this is a time when there was very quick economic development, and history shows that deflation is not a threat to our prosperity. Quite the contrary. Deflation is a result of our prosperity. And prosperity has nothing whatsoever to do with the amount of money you have in your pocket, but rather with the quantity of goods you're able to purchase with that money. If you can buy more goods with the same amount of money because prices are going down, well, then you're richer. You're more prosperous. Some people will say, yes, Maxime, if prices go down, businesses make less profit. There's less economic development. But that's not true. If prices go down, they go down across the board. And that's the same thing for businesses, because the profits made by a business rely on their sales, and if there are lower prices, there is a neutral impact on businesses because their costs go down at the same time. And that's why the fear of deflation, the fear of seeing prices go down, is absolutely unfounded. And why do the central banks intervene to prevent lower prices with inflation targets? That does more harm than it does good to the economy. And in order to get the economy going again artificially. Practically every single central bank in the world is now creating more money, expanding the money supply, which actually devalues the currency. This is called competitive devaluation, and that is the worst possible solution to use. Rich countries with productive economies have always had strong currencies. One might think of the Swiss franc or the German mark before the arrival of the euro, and the US dollar until very recently. These rich countries had very strong currencies. A strong currency means what exactly? Well, it attracts foreign investment, and a strong currency allows us to have more for our money when we travel abroad, for example. A strong currency means that our imports cost less, and therefore that our standard of living is going to go up. But when you say that, whether it's in Beauce or Montreal or Toronto, there's always someone who says, okay, but Maxime, a strong currency is not good for our exports. It means that the price of the goods that Canada exports is not as competitive, that there are contracts that are lost and jobs that are lost for those exporting companies, and therefore less wealth is created. According to them, it's better to have a weak currency so that the price of Canadian goods that are exported is more attractive to foreign buyers. That is their argument, and you hear it regularly on the television. Well, I don't share that viewpoint, and economists of the Austrian school do not share that view either, because with a strong Canadian dollar, Canadian businesses are able to buy machinery in the U.S., for example, a lot cheaper. They can invest and become a lot more productive. The price of raw materials that are needed by businesses that they buy in U.S. dollars, for example, will go down. Businesses are more able to secure capital, for example. So all of that means that our businesses are better equipped to meet competition on foreign markets if our currency goes up in relation to the U.S. dollar. And people who say that, people who say, for example, that our currency has to be weak to boost our exports, have not looked at economic statistics or looked at our economic history. If you look at those statistics, you'll see there's no connection between a weak currency and more exports, whether it's here in Canada or it's somewhere else in the world. An example is Germany. Germany has always been a country that exported manufactured goods, even when its mark was very strong. So, actually, a strong currency is a sign of a strong economy. You cannot strengthen your economy when you have a weak currency. And it's for all those reasons that I consider that central banks have very, very bad monetary policies in effect at this time by creating money out of nothing and maintaining artificially low interest rates, almost at 0%, and devaluing our currency in order to boost exports and demand for our exports. With that kind of policy, we are not strengthening our economy. We are simply encouraging inflation, encouraging or making people poor and helping them to get more into debt, and, of course, creating possibly more bubbles that will result in more economic crises. Now, one of the solutions I came forward with a few months ago was to change the Bank of Canada's inflation target, to bring it down to 0% from 2%. This year, the Bank of Canada will renew its inflation target with the Government of Canada. The Bank of Canada has an agreement on the inflation target over a 5-year period. So this year, in 2011, that agreement comes to an end on December 31st. And I am arguing for the Bank of Canada to set an inflation target of 0%. With an inflation target of 0%, there can no longer be negative interest rates. That would preserve our buying power, and it would also prevent cycles of artificial boom and real bust. And over the longer term, I think we should even have a debate and reflect on going back to the gold standard, so that Canadian currency, the Canadian dollar, is focused, is tied to the gold standard over a long term. Because gold, throughout history, has always been the guarantor of a strong currency. And that is no coincidence. If you look at the financial markets, you will see that the price of gold has gone up considerably in recent years. And that price has gone up as paper money has been devalued. Because gold is is something that people invest in, something people always put their money on. So I think we have to do away with these myths on inflation. If inflation is so great, why not have an inflation target of 100%? People say it's great. Why not 200% or 300%? You know what happens when inflation hits those levels in other countries. It means a major crisis as people lose their purchasing power. And so I want to dispel that myth, and I want more Canadians to understand the principle, because it has an impact on your everyday life. You were taxed at the rate of 45% since 1990, unless your wages went up by 45%. Ask a worker whether his wages went up by 45% since 1990. I can tell you the majority of people don't have an opportunity to have index wages. And look at your contracts, your working contracts. Sometimes your salary is indexed to 1% of inflation, but when there's an inflation target of 2% per year, obviously that has an impact on your buying power. Prices go up, and with the same amount of money, you can't buy as much. I said that at the beginning of my presentation. $1 was worth $1 in 1990. Now that dollar is only worth 70 cents. They took 30 cents out of our pockets and have been doing that for the last 20 years. So what does that mean, that kind of policy, ultimately? By having a policy of 0% inflation, which is my hope. I hope we can agree to do that with the Bank of Canada. Well, what would that do? It would preserve our purchasing power. It would allow us to create stability in the economy, and especially it would allow us to be a more prosperous country. I want to thank you for your attention, and my message today, the most simple message I want to get across to you today, is that inflation is unhealthy, and we should try to have less inflation to preserve people's purchasing power and prevent excessive debt, and also prevent the creation of artificial booms and real recessions that people have to cope with on a regular basis. If we look at our economic history in the last 30 years. Thank you very much for your kind attention, and I hope to see you again.